Analysis of financial statements involves examining a company's financial reports to gain insights into its financial performance, position, and overall health. This process helps stakeholders make informed decisions, assess risks, and understand the company's ability to generate value. Here's an overview of key aspects and techniques used in financial statement analysis. Horizontal analysis. Also known as trend analysis, this approach compares financial data over multiple periods to identify changes and trends. It helps evaluate a company's growth rate, stability, and consistency in performance. Vertical analysis. Vertical analysis involves expressing each item on the financial statements as a percentage of a key number, usually total revenue for income statement items or total assets for balance sheet items. This provides insights into the relative significance of different components. Ratio analysis. Ratios are used to measure relationships between different financial items. Common categories of ratios include liquidity ratios, assessing a company's ability to meet short-term obligations, profitability ratios, measuring the company's earnings, activity ratios, evaluating efficiency of asset utilization, and leverage ratios, assessing the company's debt level and financial risk. DuPont analysis. This approach deconstructs return on equity, ROE, into its components: profitability, net income margin, asset turnover, and financial leverage. It offers a deeper understanding of what drives a company's ROE. Common size statements. These statements express each line item as a percentage of a chosen base, allowing for easy comparison between different companies or different time periods. Comparative analysis. Compare a company's financial ratios or performance with those of its competitors or industry peers. This helps to understand how the company is positioned relative to others in the same sector. Cash flow analysis. Examine the statement of cash flows to understand the sources and uses of cash in different activities. It provides insights into a company's cash-generating capabilities and liquidity. Earnings quality analysis. Assess the quality and sustainability of a company's reported earnings. This involves scrutinizing accounting practices, recognizing non-recurring items, and identifying potential earnings management. Break-even analysis. Determine the level of sales at which a company covers all its costs and generates neither profit nor loss. It's helpful to understand the minimum sales required to maintain operations. SWOT analysis. Integrate financial analysis with a broader view of a company's strengths, weaknesses, opportunities, and threats to gain a holistic understanding of its competitive position. Financial statement analysis is a dynamic process that requires a combination of quantitative skills, industry knowledge, and critical thinking. It helps stakeholders assess a company's financial health, understand its competitive position, and make well-informed decisions about investments, credit, and strategic directions. Ratio analysis is a powerful technique used to evaluate a company's financial performance by analyzing relationships between various financial items on its statements. These ratios provide valuable insights into a company's profitability, liquidity, solvency, efficiency, and overall financial health. Here's a closer look at some common categories of ratios and their significance. Liquidity ratios. 1. Current ratio. Current assets, current liabilities. 2. Quick ratio. Acid test ratio. Current assets inventory, current liabilities. 3. These ratios measure a company's ability to meet short-term obligations. 3. Higher values indicate better liquidity. Profitability ratios. 1. Gross profit margin. Gross profit, total revenue, x 100. 2. Net profit margin. Net income, total revenue, x 100. 3. Return on assets, ROA, sad face, net income, average total assets, x 100. 4. Return on equity, ROE, sad face, net income, average shareholders' equity, x 100. 5. These ratios assess the company's ability to generate profits from sales and investments. Activity ratios. 1. Inventory turnover. Cost of goods sold, average inventory. 2. Accounts receivable turnover. Net credit sales, average accounts receivable. 3. Total asset turnover. Total revenue, average total assets. 4. These ratios gauge how efficiently a company uses its assets to generate revenue. Leverage ratios. 1. Debt to equity ratio. Total debt, shareholders' equity. 2. Debt ratio. Total debt, total assets. 3. Interest coverage ratio. Earnings before interest and taxes, EBIT. Interest expense. 4. These ratios assess a company's financial risk and leverage level. Market ratios. 1. Price to earnings ratio, PE, market price per share, earnings per share, EPS. 2. Price to book ratio, P/B, market price per share, book value per share. 3. Dividend yield. Dividend per share, market price per share. 4. These ratios provide insights into investors' perceptions of the company's performance and value. Efficiency ratios. 1. Asset turnover. Total revenue, average total assets. 2. Cash conversion cycle. Days inventory outstanding plus days sales outstanding, days payable outstanding. 3. These ratios measure how efficiently a company manages its resources and operates its business cycle. Interpreting these ratios involves considering the company's industry norms, historical trends, and its stage of development. For instance, a high current ratio might be essential for a capital-intensive business, but a low ratio could be acceptable for a tech startup. Remember, ratio analysis is most effective when used in combination. One ratio's value may provide insight, but comparing it to related ratios offers a more comprehensive understanding of a company's financial performance and position. It's also essential to use caution and context when making conclusions solely based on ratios, as there could be exceptional circumstances influencing the numbers.